Now we come to the fourth last lesson of this program of 4 days, and we are now going to cover management accounting contribution margin. Remember, for any business to create value, for any business to create value, it has to earn profit. And for it to earn profit, it has to do the costing correctly. And if it has to do the costing correctly, it has to understand the costing correctly. Please remember, in costing, when someone makes a mistake, he does not make one mistake. By default, he makes two mistakes. So if I'm under costing one product, by default, I am over costing another product. And remember, both are suicidal. And why both are suicidal from the business point of view? And that is because if I'm under costing a product, that product will sell like it's quite possible that I would underprice it also. So if I undercost a product, I will underprice it. If I underprice it, it will sell like a hotcake. But every time when I sell a unit, I am going to incur a loss. Likewise, if I overcost a product, there is a full possibility that I will overprice it. And if I overprice it, doesn't really matter as to how good that product is. That product is not going to sell because it is overpriced. And in this context, there is something very something very interesting, which Professor Robert Kaplan of Harvard University has said, and he says, better to be approximately right than exactly wrong. And this is where the costing comes into the play. First of all, let us understand the cost, and cost can be understood from three perspectives. Number one, cost can be understood as a fixed cost, and cost can be understood as a variable cost, and cost can be understood as step cost. Now, what is fixed cost? Fixed cost is a cost which is fixed to begin with, which is fixed in terms of totality, but in terms of per unit, it will keep coming down, isn't it? So the depreciation and the interest cost on the loans that I may have taken, those are my fixed costs. They will remain fixed throughout, irrespective of how much do I produce and how much do I don't produce. It is going to be fixed. But more I produce, lesser is going to be my per unit cost. So my total fixed cost is fixed, but my per unit variable cost will keep coming down. Contrary to this, what is variable cost? Variable cost, it varies. It varies with the volume, but in terms of per unit, it remains fixed. So whatever product that I am producing, let's say an automobile company, it is producing an automobile. So the raw material cost per automobile is going to remain fixed. So this is your per unit variable cost, but the total variable cost is going to increase with the increase in the activity level. And then there is third cost, which is known as step cost. Now, what is step cost? Step cost is also known as semi-variable cost. And the meaning of semi-variable cost is there are certain costs, they will not increase in the same proportion at the output as the volume. They will increase in staggered manner. So, say for example, if in my company, if in one of our plant, in the same unit, we start producing more, maybe one supervisor will be enough. But if we set up another unit, then we will need to add one more supervisor. So your step cost is the cost which does not increase in the same proportion as the variable cost will increase. The cost can also be understood as direct cost and indirect cost. And let me tell you, friends, it's very simple.